Okay, hello everyone. So this is the Energy Economics, Environment and Policy class at Keio University. Today we are honored to have a distinguished speaker, Professor Naoyuki Yoshino, who is a Professor Emeritus of Keio University and former Dean and CEO of the Asian Development Bank Institute, and he is currently the Director of Financial Research Center, FSA of Government of Japan. So Professor Yoshino was my supervisor, PhD supervisor, and I learned a lot from him. So today he accepted my invitation to give a lecture on large-scale green projects and ESG investment. Professor Yoshino, please.
Right. Thank you very much. Good afternoon. My name is Naoyuki Yoshino. I used to be the professor of economics at Keio University from 1990 to 2014. And then I became the Dean and CEO of Asian Development Bank Institute, where I stayed about 6 years. Then I'm now a director of Financial Research Center, FSA, which is a regulator of the banking, finance, insurance, securities, and government of Japan. So today, I'm going to talk about two topics. First one is large-scale green projects. How could we possible to finance to them, such as a big hydro dam, which can provide a large scale of power. And then second part, I'm going to talk about ESG investment and current definition by various rating agencies may distort optimal portfolio allocation. So I'm going to propose net taxation on greenhouse gas in the second part. So those are the two topics I'm going to talk to today. First part, I'm going to talk about large-scale projects. Many of you might have heard about public-private partnerships, PPP, public-private partnerships. It means if the project is large, government sector does not have enough money, and then government would like to invite private investors into the projects. And such projects are hydro dam and big energy projects. In many developing countries, governments are now facing with huge deficits after COVID-19. So they are planning to invite private investors in large green projects. So this is the scheme, and many public-private partnerships in the past failed in Asia and Latin America. And I'm going to talk why, and then what would be the remedies to bring private sector investments in large green projects. You can see in this diagram, in the middle is the green infrastructure or infrastructure in general. The left-hand side are users. Traditionally, major sources of revenue for infrastructure came from user fees. For example, railway, highway, water supply. All these infrastructure, they relied on user fees. Suppose private investors would like to put their money into large hydro dam. Then on the right-hand side, private investors prefer higher rate of return. But those electric power supply, many people are using it. But left-hand side, users prefer low prices, low fees. So PPP, public-private partnerships, private investors preferred higher rate of return, but users preferred low fees, which applies to electric power supply, water supply, and so on. So there's a conflict between private investors and users. This is why many public-private partnerships, PPP, in Asia and Latin America had failed. Users prefer low fee, but on the right-hand side, private investors prefer higher rate of return. So there was a conflict between the two. And this is the cases of failed private financing in infrastructure investment. Total failure, and among them, 54.5% of the failed cases came from developing Asia. And then Latin American case, 40.4%. Because all these infrastructure relied only on user fees. So user fees preferred, for example, electricity, water supply. They are necessary goods. So they cannot increase the price of water supply or electric power supply. Then private investors cannot earn enough rate of return. That is the reason why many public-private partnerships, PPP, had failed. However, after COVID-19, many developed countries are facing with budget deficits, and they have to rely on private financing into green projects and various infrastructure investment. If we use the same method, then we will accumulate lots of failures, and private investors will not come into green projects. So I'm going to propose what would be the best way to bring private financing into infrastructure investment. Traditionally, infrastructure relied on user fees only. And suppose R here is the market rate of interest. Most of the projects have lower rate of return than this market rate, so black line. And there are some risks, so I'm putting those dotted line. And if all these projects relied only on user fees, then the rate of return will always lower than the market rate, because electric power supply, water supply, roads, and railways, they are necessary goods for everybody. Then how could it be possible to bring these low rate of return to the red line, which will become higher rate of return than the market rate? So this way, user fees are low, but private investors can receive higher rate of return. So please come back here. How could it be possible to keep user fees low and then increase private investors' rate of return? So that is what I'm going to propose first part in today. So I have been looking at the impact of these greenhouse large projects. For example, electric power supply. That has a huge spillover effects into the region. This is the chart. So big hydro dam, which is now under construction in Asian ASEAN region. Then this electric power supply can supply electricity to many surrounding countries. And traditionally, these big hydro dams relied only on user fees. Then the rate of return were very low. However, this electric power supply has a huge economic impact into the region. Electric power supply, then new housing will be constructed, new restaurant will come there, and new manufacturing industries will be started in the region. So in other words, electric power supply can create big economic impact into the region. This will lead to huge increase of tax revenues, property tax, income tax, sales tax, and corporate tax And all those tax revenues will rise because of this electric power supply. However, in the past, all those tax revenues went to the government. And these infrastructure companies relied only on user fees. That was the causes of why their rate of returns were very low. So I'm going to propose first to measure these spillover effects created by electric power supply, and then share those increased tax revenues between the government and infrastructure investors. That can increase the rate of return for so many years. So this is the chart. Suppose electric power supply has been constructed. Then in that region, the tax revenue will become red line because regional development will increase various tax revenues. As I explained, corporations will start their business. Small business can open their restaurants and so on. So that will increase sales tax, corporate tax, income tax, and property tax because new housing will be constructed. And this will continue as long as good infrastructure can be created. And blue line is a region where there are no such electric power supply. In many Asian countries, rural area is lack of electric power supply. But in the cities and developed regions, they have electric power supply. Then we can measure how much tax revenue had been created by these greenhouse electric power supply. Then I'm proposing these increased tax revenues should be shared between the government and also electric power supply operators and investors. This will increase their rate of return because electric power supply, their companies are not only relying on user charges, but also spillover tax revenues will come as a revenue to their income every year. So this is a paper with Professor Farhad, the way to induce private participation in green finance and investment. And I can send you this paper so that you can understand the essence what I'm going to explain now. Then we can look at, in general, how much infrastructure can create spillover effects. In this diagram, there are three rows here. First one is direct effect. Infrastructure, construction, infrastructure itself has an impact. Second one is the spillover effects. Infrastructure can bring private businesses into the region, manufacturing industries, services sectors, and so on. Then this will increase employment into the region because new businesses can start by the supply of electric power. So there are two impacts into the private business. One is capital stock because new businesses comes into the region, and then employment will be created. And how much those capital stock and labor will increase total output, total production in the region. Then we can compare the infrastructure itself, direct effect, and also spillover effects. Then in case of Japan, 66% or 68% of total impacts of the increased GDP comes from spillover effects. And direct effects are about 1/3, and spillover effects are about 2/3. So it is quite large. The infrastructure can bring big businesses into the region, and that will increase the tax revenues. So if this tax revenue were shared between the government and the infrastructure investors and operators, then the rate of return will rise just like in this way. So traditionally, infrastructure relied on only user fees. Once we will bring these spillover tax revenues and share it with the government and infrastructure operators and investors, then the rate of return will become much higher. And this increase will be much, much bigger if the spillover effects are very large. Then the rate of return will go beyond the market rate of return, and many private investors are very happy. So this is my proposal for the big hydro project, so that can bring private sector finance into infrastructure. In the past, all these infrastructure only relied on user fees because electric power supply is a necessary goods. So the price has to be very low. And without sharing this spillover tax revenues, then private investors could not achieve higher rate of return. Then I have estimated various infrastructure investment. This is a case of highway, expressway in Manila. T-2 is before the construction started. This is a total tax revenue in Lipa City and Batangas City. If some of you are coming from the Philippines, you know these cities' name. Then T-1 and T are the construction period. And T+4 is after the construction has completed and fourth year. Then you can see the tax revenue had increased about 3 times as much as before. So this highway has big spillover effects into the region. And this is a railway, Uzbekistan's case, that has a positive impact into agricultural sector and industrial sector and services sector. And in total, about 2.2% growth along this railway compared to other regions. So it's a significant impact into the region. And this is Japan's high-speed railway in Kyushu. In Japanese, we say Shinkansen, express high-speed rail. Then total tax revenue had been increased about twice as much as before. Personal income tax, corporate tax has significantly increased after this high-speed rail has been completed. So in this way, the spillover effects are significant, and that should be returned to infrastructure investors and infrastructure operators. And this is the digital infrastructure in case of India, communication and mobile infrastructure. You can see after the completion of this digital infrastructure, tax revenue has significantly increased. And in the Indian case, the increment of these spillover tax revenue came to about 14.2% increase of total rate of return. So it's a significant increase for private investors. Then they can come into these projects. And this one I proposed in India at the G20 March 1st. So this was my newspaper article about my proposal of spillover return to digital infrastructure in India. And then I presented 2 weeks ago in OECD about this electric power supply and greenhouse project should be provided the spillover effects, and that should be shared. And this project was Africa and Europe. So this side, there are many African ministers and finance ministers are here. And left-hand side is the OECD European staff. So this was my proposal at the OECD. Next, I would like to talk about the floating infrastructure bond. If we want to bring private sector financing. As you can see here, during the construction period, there is no return. When the construction is completed, and then operation starts at period T1. But revenue and the economic developments are not so large, and it is becoming very gradual. At point T3, the total rate of return becomes higher than market rate of return. Many infrastructures, big infrastructure, like electric power supply and hydro dam, it takes several years so that these spillover tax revenue can be realized. Of course, after those impact, then these spillover effects will keep on rising because of development. So first few years, private investors could not earn any money, construction period, and also the first part of operation period. So in order to bring private investors, this is my idea. We can give the same interest rate as a government bond. R star is the rate of interest of government bond. So private investors can receive the interest receipt the same with the government bond at point T3, where the spillover tax revenue exceeds those government rate. Then their rate of return becomes this red line. So their rate of return becomes higher than government bond. But it may be important to have some cap ceiling. If the rate of return becomes more than 15%, it may be too much. So government can stop to increasing the rate of return, but government can keep on receiving those spillover tax revenues. Then these blue shaded line will exceed this red part. Then government will not lose, and private investors are happy because their first part of losses are all compensated by the government, and then spillover effects of the government will become very large. So this floating interest rate infrastructure bond can be applied to large greenhouse gas projects. Next, I would like to talk about small-scale green projects. So far, I was talking about big hydro dam. It requires huge amount of money. And in those projects, we needed large investors, such as pension funds or insurance. Those are the two big suppliers of long-term investment. In many European countries, insurance and pension funds are very large. And also in Asian countries, pension funds are started to be growing. And insurance companies like in Vietnam and Indonesia are growing, and Thailand. So these large projects can be started to be financed by those institutional investors, such as pension funds and insurance. But there's another type of green projects, such as solar power. It is a small-scale project compared to large-scale project. In Japan, the wave power in the ocean is becoming very popular. Then I'm proposing those financing could come by crowdfunding. And crowdfunding, many people into the region and contribute about 10,000 US dollar or 20,000 US dollar. And then 250 people will come to get together that can construct one wind power and or one solar power. And this can be used for many places in Japan. Then in order to increase the rate of return for these solar power, we can use spillover effects into the region. And also we can return the net tax on fossil fuels, which I'm going to talk about later on. That can keep the enough revenue for green energy projects. So it is important. There are two taxes are important. First part, I was talking about spillover tax revenues created by electric power supply and infrastructure. And second part, it is important to tax on fossil fuels, tax on CO2 emissions. And that can become the revenue sources to increase the rate of return on green projects, not only large projects, but also small scale projects such as solar power, wind power, and wave power. So this is the example scheme which has been developed in many regions by community wind power projects. So investors are left-hand side, $100, $200, $300, and 250 people get together, then one wind power can be constructed. And then in order to keep the rate of return to stable manner, I'm going to propose the injection of net carbon tax so that these green power projects can have enough secured rate of return. As far as this net tax, I'm going to talk about in the latter part of my lecture today. Okay, so this is the first part of my presentation. Then next, I would like to talk about the second part. Second part is ESG investment. And I'm going to talk about current definition of ESG by rating agencies will bring distorted portfolio allocation. And I am going to propose the best way to remedy these distortions by ESG. We have to charge net tax on greenhouse gas emissions. And that collected greenhouse gas emissions tax revenues can be used to encourage green investment and to increase the rate of return from green power projects. So that is my second part of lecture. This table, which I'll give my PowerPoints later on, shows the example of the definition of ESG by different rating agencies. On the left-hand side here, 5 rating agencies have been picked up: Bloomberg, Financial Times, MSCI, Sustainalytics, Thomson Reuters. So these are the 5 famous rating agencies. When I looked at how they score the company based on the ESG criteria, for example, Bloomberg, they are looking at the degree of disclosure. They are looking at disclosure booklet of various companies and how many pages they are talking about environmental issues. That is the criteria they talk about the score of each companies by Bloomberg. And second one is Financial Times. Then they are also looking at disclosure, and also they interview the commitment of directors and senior people and their employees and how they are serious for the environmental issues. And MSCI defines 37 key ESG indicators by themselves. Then based on those 37 indicators, they evaluate each company and make scores for each companies. Then Sustainalytics, they are looking at information disclosure. And Thomson Reuters defines 10 items to measure their ESG environmental scores. So as you can see here, each rating agency has their own definition, and then they measure the company's environmental score or greenness score, and then you can find from here, you can guess. Then the scores are different by different rating agencies. Yes, that is so. So each rating agency has a different score to each company because their criteria of measuring environmental green scores are different from one company to another. Okay, and this is another interesting about Bloomberg. Even within Bloomberg, region by region, their definition of scoring greenness are different. So not only rating agency by different rating agencies, but also the same rating agency such as Bloomberg. Then depending on the region, they have different definitions for scoring greenness index. So this shows that the evaluation of ESG, I'm focusing on environmental scores. And if we include social and governance, then scores becomes much, much diversified. So in this paper, I'm focusing on environmental scores. So some rating agency is looking at their company's efforts and degree of disclosures and emission of carbon dioxide and so on. So each rating agency has different definition of ESG scores. And this is the Japanese pension funds, government pension funds. It is called GPIF, government public pension funds. Then even these pension funds has a different weight for measuring the investor's company. This government pension funds, GPIF, is investing into various companies in Japan and also overseas. When they invest into Japan, ESG, environment, social, and governance, they are focusing much more on environmental scores and relatively low in social and governance scores. But when this government pension funds invest into overseas, then they are also looking at social S score and governance G score and environment scores, ESG scores. So as you can see here, the same investor has a different weight for E and S and G where they are investing. So when they invest into Japan, they focus mainly environmental scores. When they invest overseas, not only environmental scores, but also social S and governance scores are taken into account. Next, I would like to talk about green bond. The same thing can be applied to green bond. This is a definition in 2018, and then they revised this definition in 2022. So these 10 criteria are the same with 2018 and 2022. For example, if we look at renewable energy, then if it is a solar power, they can issue green bond and then collect money by selling green bond. Energy efficient building, then they can issue green bond and collect money from investors. So about several years ago, at Otemachi in Tokyo, the green building was at first constructed several years ago. So I interviewed those construction companies about this first green building constructed several years ago. And then there are so many green buildings has been kept on constructed in Japan. And then they issue green bond to collect money from investors. Then I asked, how much % of CO2 is your building has been reduced? Then they said, I'm sorry, Professor Yoshino, we don't know exactly how much CO2 has been reduced. However, we are sure elevator is much more energy efficient, and room's ventilation is much, much better, and walls are much better not to absorb heat, and so on. So this building is much better compared to traditional building, maybe 30–40% cut of CO2. However, we don't know exactly how much our building has been reduced CO2 emission. Then I interviewed another building, but the same answer. So this means energy efficient building, as long as their criteria is satisfied, then this ICMA, International Capital Market Association, allows these companies, you can issue green bond. But as you can see here, some of the buildings, 25% CO2 cut. Another building, 40% CO2 cut. Both of them can issue same green bond. So this will again distort the market, because some of the green bonds are very, very purely green, but another green bond may be gray. But both of them can issue green bond because their ratings are not well established. Then I'm going to talk about this will distort the optimal portfolio allocation. I apologize, I'm using mathematics, but you don't have to worry about in detail. Please look at equation 17. Traditionally, investors are looked at rate of return R, and sigma square is the risks. So rate of return and risks, those are two parameters, two variables investors are used to look at. And beta is the risk appetite. If beta is very large, then this investor is caring about the risks. But if beta is not so large, then that investor is mainly focusing on rate of return. So traditionally, investors looked at rate of return and risk. So those are the two indicators they used to watch when they make investment. However, nowadays, they have to pay attention to greenness or ESG score or SDG scores. So not only rate of return and risk, but also they have to pay attention to greenness or ESG or SDG. If that is so, then their portfolio allocation will become equation 23. So this alpha is the allocation of their investment into company A and company B. Here, I'm just giving example of two companies. You don't need to follow all these equations. This is a rate of return, and this is the risks, and this is a greenness index coming from two companies, company A and company B. And here, I'm assuming alpha percent, for example, 6% of your money is invested into company A, and 40%, 1 minus alpha, is invested in company B. So I'm thinking about investment, you are, for example, 10,000 yen into two companies. What is the optimal allocation between two companies, alpha T minus and 1 minus alpha T? 60%, 40%, or 30%, 70%, and those are the alpha where investors are looking for. And traditionally, this alpha depended on risk appetite, rate of return, and risks. However, once investors have to pay attention to greenness or ESG or SDG, then greenness score comes into the decision-making of portfolio allocation. So that means the greenness scores are very important, or SDGs or ESG scores are very different. However, we have seen these scores are different by rating agencies, one rating agency to another. Their scores for the companies are different each other. So that will distort this optimal portfolio allocation. Traditionally, investors only paid attention to rate of return and risk. Then they decided alpha T. These rate of return and risks, they are looking at based on the same criteria. However, green index or ESG index, they are different from one rating agency to another. So this will distort the optimal portfolio allocation. I apologize, this is a little bit complicated way to show how these different scores of greenness will bring distorted portfolio allocation. You don't have to follow everything, but traditionally, when investors are looked at rate of return and risk, then point E, based on this AB portfolio frontier and utility maximization, point E was the optimal. However, they have to pay attention to greenness or ESG score or SDG. Then this vertical axis is looking at company A, B, two companies' rating scores. As I said, depending on rating agency, then this score is different. Some rating agency shows a black line of scores between company A and company B. And different rating agency give score C and score D to the same company, B and A. So each rating agency has a different curvature in the vertical axis. Then if we bring it back to the horizontal axis, you can see the optimal portfolio allocation will become point F if we ask this rating agency black line. If we adopt the green line rating agency, the optimal portfolio allocation will become G. So in this way, the portfolio allocation will be distorted. So if this distortion becomes very large, then country as a whole or institutional investors as a whole will have distorted portfolio allocation. And that is not good in the long run. So this is an empirical example for rating agency 1, rating agency 2, and rating agency 3. And we picked up two companies, company A and company B. Then rating agency 1 shows score 8.6 and 1.8. Then when you look at rating agency 3, this score will be reversed. Company A has smaller score compared to company B. So this shows depending on the rating agency, their scores are different. Sometimes the scores are reversed. Then based on these scores, optimal portfolio allocation, company A is 71% and company B 29%. Then rating agency 2, 74% should go to company A, 26% should go to company B. And then rating agency 3, 54% to company B, company A, and 46% should be company B. So in other words, which rating agency investors will consult with, then the optimal portfolio allocation will be different. So this shows the distortion of portfolio allocation depending on the rating agency. So this paper is shown in myself and Mr. Yuyama. Next, I would like to talk about green central banking and monetary policy. In many European countries are discussing about central bank should purchase green bond rather than ordinary government bond. Right-hand side used to be the traditional central bank. Central bank purchases government bond from the market, and then they print money and supply money. That is the simple monetary policy. So they purchased ordinary government bond and supplied monetary base into the economy. So this was the traditional central bank. In Japanese case, after the Governor Kuroda came into power, he started to purchase huge amount of government bonds by increasing monetary base, money supply, monetary base. So that is what the Governor Kuroda did. However, Governor Kuroda purchased ordinary government bond. But in the UK and several other countries, the economists and governor are talking about central bank should purchase green bond, not only ordinary government bond. And I'm very skeptical about the type 1. And I think type 2, traditional banks would be better. The reason is the following. Fiscal policy determines how much money should be allocated in each sector: education, infrastructure, green sector, environmental improvement, and so on. How much government should spend in those sectors, that is under fiscal policy. Then in order to allocate education, infrastructure, green sector, they collected tax, and also they issued government bond. And part of these government bonds were purchased by the central bank, and then central bank printed money. So central bank is neutral where the budget is allocated. So budget allocation is under fiscal policy. That's why central bank only purchased ordinary general government bond rather than purchasing green bond. But if the central bank start to purchasing green bond, then the central bank is allocating additional amount of money to these green sector. Then suppose infrastructure started to issue infrastructure bond. Should the central bank purchase infrastructure bond? If the education sector start to issue education bond, should central bank purchase education bond? Then once they start purchasing specific government bond, then they have to explain why they are purchasing green bond. Of course, central bank said green sector is very important, but that is a role of fiscal policy where the Diet will decide how much money should be allocated to green sector, infrastructure, and education. Then it is better for the central bank to be neutral rather than specifically putting their money into one sector. And as I said, they said green bond is very important. But some Asian countries, infrastructures are very important. Then infrastructure, they may start to issue infrastructure bond. Then there may be a pressure. Why don't central bank purchase infrastructure bond? And education is very important to everybody for human capital development. Then education bond should be purchased by the central bank. Then how much should they purchase education bond? How much should they purchase green bond? How much should they purchase infrastructure bond? Then that will come into the allocation of fiscal policy. So I think that is why central bank used to be number 2, and they have never specifically purchased specific government bond. And that is one point I'd like to make. Second one is green bond itself is not purely green. As I said, some of the green building, they issue green bond. And suppose the central bank purchased those green bond. Then some of the buildings are 20% CO2 cut. And another building is 40% CO2 cut. Both of them can issue green bond as long as they satisfy ICMA International Capital Market Association in France, Europe. If as long as they satisfy those criteria, then they can issue green bond. But some of the green bonds are 20% CO2 cut, another green bond are 40% green CO2 cut, and that will distort the optimal allocation of money. So that is the second problem for the central bank to purchase green bond. Last 2 points. One is about the small and medium-sized MSMEs. OECD study shows micro, small, medium-sized enterprise. Sometimes we say SME, or sometimes we say MSE, micro, small, medium-sized enterprises. More than 50% of CO2 emissions in the world are coming from SMEs or micro SMEs. So in the bottom part, this part will exposes CO2 emission more than 50%. But market pressure always comes from stock market and bond market. Small businesses do not issue stocks and bonds. So only the pressure from the market comes to large businesses. So many small and medium-sized enterprises, almost all of them, do not issue stocks and bonds. So there's no market pressure for their CO2 emission. And they know environment is very important, but they don't have enough money to spend their money for their improvement of equipments compared to large businesses. So all the SMEs say environmental issues are very important, but they cannot spend so much money for improvement of CO2 emissions. This applies especially so to developing countries. Many small businesses in developing countries do not have enough money to improve their CO2 emission, even though they know it is important. So large companies has pressure from stock owners and green bond owners. But small businesses, they issue more than 50% of CO2. They cannot improve. Then I'm going to talk about, in order to remedy these distortions, carbon tax and net carbon tax is very important. And nowadays, CO2 emissions are possible to be measured. For example, satellite photo, they can measure the CO2 emission even for each household and small businesses and large companies, and how much CO2 that each household is emitting. And in Yokohama City, all the schools have this equipment. Then the student can look at temperature and CO2 emissions of their classroom. So if these equipments are set it up into small businesses and large businesses, all the rooms, it is possible to measure CO2 emissions. Then we can charge tax on carbon emissions. And then, but I'm going to propose net carbon tax. For example, steel industries and auto industries. So far, they have to issue huge amount of carbon. Then they cannot escape from carbon tax. And some of the services sectors, their carbon emissions are very low. So I'm proposing the net carbon tax. So that means amount of carbon emission minus their greenness efforts. Greenness efforts means if the company is planting trees or planting seaweeds into the ocean, or they have putting the solar power panel on the rooftop, then that can be deducted if they can reduce CO2 emissions. And also carbon trading can be possible to reduce these actual carbon emission in steel industries and so on. So I'm going to propose net carbon tax in order to make aware even for small businesses and developing countries and so on. And if this carbon emission, net carbon tax is levied, then investors can only pay attention to after-tax rate of return and after-tax risks. They don't have to pay attention to the CO2 or greenness or ESG or SDG scores, because all of them are already captured by net tax. Then this portfolio frontier will become red line, and then the optimal portfolio allocation will achieve by point T, so the investors do not need to pay attention to ESG score or greenness score, but they can look at after-tax rate of return and after-tax risks. That is the same two-parameter approach, rate of return and risk, traditionally investors were using. So this will be the best policy in order to remedy distorted portfolio allocation. And also this net tax can be charged to small businesses, but gradually. Large businesses may have certain tax rate, but small business can be started, for example, 0.001% tax rate. However, whatever the small tax rate, small businesses can aware because they have to pay tax. Then they can improve their production and so on, step by step. Then these tax rate can be increased in 10 years or so. The same thing can be applied to developing countries. Developing countries always say lots of CO2 emissions come from developed nations. However, developing countries, they are also exposing their CO2. So those developing countries, smaller rate of tax at the beginning, and then 10 years or up to 2050, they should gradually change their tax rate so that both advanced nations and developing nations, large businesses and small businesses, by 2050, the tax rate could be the same to everywhere. So that's all my presentation. And then at the end of my lecture, I put these papers, and almost all of them together with Professor Farhad Taghizadeh-Hesary. So any comments and questions are welcome. Thank you very much for your listening.
Thank you very much, Professor Yoshino, for your interesting presentation as always. So it was very informative, lots of information provided.